Welcome to The Explainer. Today, we're jumping into something that's absolutely critical for any business in the UAE. We're going to decode the hidden journey your profit takes from what you see in your financial statements to the actual number you end up paying tax on.
So let's get right to it with a big question. Is the profit you see on your books, your accounting profit, the same as your taxable income? The short answer, almost never. And you really need to know why.
Think of it like this. Your accounting profit, that's your starting point. It's what your books say you made. But your taxable income, that's the real destination. It's what the UAE corporate tax law actually considers to be your profit. And trust me, those two numbers can be worlds apart.
So, in this explainer, we are literally going on your profit's hidden journey. We're going to follow that path from your financial statements all the way to your final tax base, and I'll show you exactly how that transformation happens. So what exactly is taxable income? Well, officially, it's your net profit after you apply a bunch of specific adjustments that are laid out in the law. And that's the key thing to get here. You don't just find this number on a report somewhere. You actually have to calculate it. Let's move on and see how this all works. The entire calculation really comes down to adjusting your bottom line. And we do this with two main tools. Things we get to subtract from our profit and, well, things we have to add back in. These are the adjustments that really shape your final tax bill.
Okay, let's start with the good news, the income you get to subtract. The law says certain profits are exempt. We're talking about things like dividends you receive, or maybe capital gains from selling shares in a subsidiary. It could even be profits from some of your foreign branches, or certain money transfers inside your own corporate group. Basically, this is all income you earned, but you don't have to pay tax on it. Pretty great, right?
Now, you might be wondering why. Well, there's a real logic behind this. These exemptions aren't just random. They're designed to make the UAE a super attractive place to do business, to encourage investment, both at home and from around the world. And now for the not-so-good news, the expenses you have to add back. These are real costs, money that actually left your company's bank account, but the law says, nope, you can't deduct that. Things like fines or penalties, the government isn't going to give you a tax break for that. The same goes for any illicit payments. And personal expenses, those are for you, not the business. As for dividends you pay out, the law sees that as sharing the profit after tax, not an expense to earn the profit in the first place. All right, theory is one thing, but let's make this really concrete. We're going to walk through a simple, practical example to see this journey from accounting profit to taxable income in action. So meet our example company. Let's say their books for the year show a net profit of 600,000 dirhams. Now, during that year, they also received 70,000 in dividends that are exempt, and they had 50,000 in expenses that, you guessed it, aren't deductible for tax.
Okay, so step one, it's always the same. We begin with our starting point, right? That's the accounting net profit from the books. For our company, that's 600,000 dirhams. Easy enough.
Next, we make our first adjustment. We have to take those 50,000 dirhams in expenses that aren't allowed and add them back. Even though the business spent that money, for tax purposes, we have to act like it didn't. This brings our profit base up. Now for the good part. We get to subtract the income that the law says is exempt from tax. Our company got $70,000 in dividends, so we can take that whole amount right out of our calculation. And that, of course, brings our profit base down.
And there you have it. We started at 600,000, we added back 50,000, and then we subtracted 70,000. We've reached our destination, a taxable income of 580,000 dirhams. This is the number that matters. This is the number the tax authority looks at.
So we've completed the journey and we have our number. But why is getting this right so incredibly important? Well, that brings us to our final and maybe most crucial section. Compliance is key. Look, the stakes here are really high. It's simple. If you get it wrong one way, say you forget to subtract some exempt income, you end up overpaying your tax. You're just giving away money. But if you get it wrong the other way and deduct something you shouldn't have, you risk underpaying and facing some pretty hefty penalties. So what's the takeaway? Here's a quick checklist to keep you on the right track. 1. Be absolutely meticulous about categorizing your income and expenses. 2. Make sure you know about and apply every single exemption you're entitled to. 3. Document everything. You need a paper trail to justify every adjustment you make. And 4. Keep detailed records of it all, because you need to be ready if they ever get reviewed. And that's the whole journey, from one profit number
to another. In the end, it all comes down to a final, really critical question for every single business owner. When you look at this process, you have to ask yourself, are you managing your tax or is it managing you? Because making that choice, well, that makes all the difference.